Welcome to Tim's Strategy of the Week series. Today I'm going to show you the mean reversion strategy. Stay right where you are. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of the Strategy of the Week. Today we're going to look at the mean reversion trading strategy. So, mean reversion trading, what the heck is that? Mean reversion trading assumes that over time the prices of any asset, be it a stock, commodity, forex currency, cryptocurrency, whatever, in time will revert back to the mean or average price. In other words, reversion to the mean comes down to the old saying, what goes up must come down. The concept of mean reversion forms the foundation of many trading strategies that involve buying and selling when the price has deviated from their historical averages. The idea is that in the long term, prices will return back to their previous average prices and normal pattern. Examples of mean reversion trading strategies include reversals, pullback trading, retracement, range trading systems, and overbought and oversold strategies. These are typically any strategy that identifies extreme price movement in an unexpected direction. Our mean reversion strategy is to trade those price changes that occur after an extreme price move and continue. In essence, mean reversion is playing around a central value in the middle of the range or a moving average. The reversion to mean trading system tends to produce a higher win rate in those instances where we see extreme changes in the price. The trick is determining what an extreme price change is. Obviously, as with every trading strategy, this is not magical. There is always a possibility that the price will not revert back to its mean. This can indicate that there is a real shift in the market sentiment and we're actually in a new paradigm. With mean reversion, we're looking to trade against the herd. A lot of times when you're doing mean reversion trading, you'll be in and out of a trade quickly because the price will often quickly snap back to the average. There are several different ways to trade with the mean reversion strategy, including the price stretch from a simple moving average strategy, a break outside the Bollinger Band strategy and a return back to the mean, a test of support and resistance strategy while the price is consolidating. Here we see a regression channel where the center line is the linear regression. The center line is simply the average price going from the initial point we used to draw the line till the end. The linear regression is clearly sloping upwards and it's acting as a magnet to the price. Each time the price deviates from the average price line, it snaps back to it, demonstrating the reversion to the mean concept. The main advantages of the mean reversion strategy include effective exit strategy. The take profit target is always the average price, a high win rate. The shorter the mean reversion time frame used, the higher the win rate, and lastly, good risk-adjusted returns. Of course, all trading strategies have their own pros and cons. The biggest flaw is that once you're in a trade, you'll often see a loss before you see a profit, depending on how you time the entry, because as you know, the market doesn't operate on our schedule. As with any trading strategy, the main components of the mean reversion strategy should include an entry price after the price has moved away from its average price. You can simply calculate how far percentage-wise we are from the mean, or use an ATR, multiple declines, or simply use a volume oscillator to gauge oversold and overbought readings. Number 2, an exit signal gives you a way out once you get into the trade. And number 3, broad market timing. Mean reversion is a key part of how all financial markets work. Mean reversion happens partially because the prices have a tendency to overshoot and undershoot their intrinsic value. These price anomalies happen because the impact of new information takes time to be digested by the market. Also, it takes time for the market to establish a fair value. But if you've been on this channel for a little while, you've heard me say this many times. Trading works because prices move on collective emotions, and that includes the concept of price reversion to the mean. For markets that have intrinsic value, which basically is anything that's not forex, what this means for traders is that the price tends to overshoot to the downside a bit more than they overshoot to the upside. This is true because fear tends to be a bigger emotion than greed. Of course, I don't include Forex in that statement, since Forex is about trading one currency against another, so what is down for one of the pair is up for the other, which negates this concept. So let's build a strategy based on what we know about mean reversion. The best mean reversion strategy you can possibly use is the one that can help you capitalize on choppy or ranging markets. During a consolidation period, the price will get stretched to the upside and downside multiple times. The price will tend to snap back from these overbought, oversold readings. As with any job, selecting the right tool is important. There are a variety of indicators that calculate in some form or other extreme and unusual price movements. With mean reversion trading, timing the market is critical. So here are some of the most popular tools you can use to time the market. The RSI indicator can be used to spot extreme overbought or oversold price readings. The standard deviation, Bollinger Bands, money flow, and moving averages can be used to spot extreme price movements. The Ichimoku cloud strategy, which is based upon the price deviation from the cloud, can also be useful. Here's a great example using the Bollinger Bands. The ranging period starting from August through November has generated 4 sell signals and 3 buy signals, which all eventually reach their target. The profit target in this case is the middle band. Next, we're going to take a look at a classic method to reduce your drawdown. Usually the mean reversion trading strategy has low drawdown, but that can be reversed even farther. But before we get to that point, let's take a look at the tools we need to use for this strategy. The best mean reversion indicator that works 85% of the time is the RSI indicator. So start with the RSI oscillator on your charts. One modification we're going to suggest: the RSI settings must be changed from the default 14 period to a 2 period RSI. So we'll have not just any type of RSI, but a very fast RSI. The other technical indicators we're going to deploy on the charts are the 10 period simple moving average and the 200 period exponential moving average. Here's what your chart would look like with those indicators set up. The recommended time frame for this strategy is daily. Intraday charts won't work well because the fast period RSI will generate a lot of false signals on lower time frames. Now let's see how we can combine the 3 indicators into a profitable mean reversion strategy. The first obvious question is, what are the buy and sell signals? Let's start by seeing what a buy signal might look like. The mean reversion trading strategy needs to satisfy 3 triggers. First, the price needs to be above the 200-day EMA. This means that the overall price is in an uptrend, and we're only going to look for buy signals in bull markets. Second, we look for the price to be below the 10-day SMA, which shows a deviation from its mean. Last but not least, we look at the RSI to overshoot below 10, which signals that we're in oversold territory. Once all 3 conditions are satisfied, we enter a trade at the open of the following day. Once we're in the trade, we need to know when to exit the market. This is where the 10 period simple moving average comes into play. What we're looking for is for the price to reverse back to the 10 period SMA. More often than not, the price will overshoot to the upside and break above the 10 period SMA. So to fully capitalize on the entire move, we use multiple take profit targets. The first profit target is to close half of the position once we touch the 10 period SMA. The second portion of your position is left until we break and close above the 10 period SMA. Based on our backtesting results, on average your trade should reach the second target within 1 to 3 days. The longer you keep your position open, the lower the chances of the trade to succeed. As a general rule, you should cash out of your entire position within the first 3 trading days. Now, the most important part: managing the risk. When it comes to the stop loss, we're advising not to place a stop loss right away, but instead to use a time stop. So let me take a minute to explain. Based on our backtesting results, we have found that a lot of the times the market will do a false breakout below the previous day low or high and hurt our position. So to avoid this scenario, we've found a great trick to avoid it. Our rule is very simple. If by the first half of the day our position shows a loss, we close that trade and call it a day. This is a risky play, but we have the edge on our side to play this kind of trick. After all, trading is a risky game, and everyone needs to decide for themselves how to manage risk. If you're uncomfortable setting up a position without a stop loss because, well, it's the market, and who knows what some idiot politician may say at any moment to make the price just go totally wacky. If that makes you uncomfortable, you can choose a spot way below the price action to place a temporary protective stop until you hit the first target, and still continue to use the time stop that I mentioned. Obviously, of course, sell signals use the same trading rules, but in the opposite direction. In summary, the coolest thing about mean reversion trading is the high win-loss ratio and the simplicity behind the whole thing, and I definitely like simple. One thing to keep in mind is that the mean reversion strategy tends to perform poorly when the market is trending hard, but that shouldn't be much of a big deal since the market is ranging 75% of the time. So the key takeaways from the mean reversion trading strategy are as follows. Mean reversion can be used with all asset classes, including stocks, commodities, currencies, cryptocurrencies, etc. Range trading and overbought, oversold signals work the best with this method. Adjust the RSI setting to a fast period. You can generate quick profits due to short holding time periods. And as a trading tip, use a time stop instead of a price stop. Okay, that's it for this week's strategy. Be sure to come back next Wednesday at 3 p.m. as we continue to discuss the volume indicator in our trading education series. Don't miss my trading picks of the week on Mondays and my strategy of the week on Friday right here at Trading Strategy Guide's YouTube channel at 3 p.m. New York time. Be sure to subscribe and hit the bell so you'll be notified when these videos come out. Have a great weekend, and I'll see you with a couple of trade picks on Monday.